Ever met someone who owns a house, holds a stock portfolio, pays a mortgage every month, yet somehow keeps getting richer instead of poorer? Their net worth grows steadily year after year, and they are nowhere near trapped working until they're 65. Your first instinct is to think they have family money, a handout from wealthy parents. But then you find out their parents are just ordinary civil servants who never gave them a single dime. Your second guess is that they just bought property early, catching the massive wave of rising real estate prices in Taiwan. But when you look closer, their timing wasn't particularly early, and their real wealth didn't come from property appreciation anyway. It came from one specific move they made with that house. That move is a cash-out refinance. There is a group of people in Taiwan who use their primary residence to refinance, secure low-interest funds from the bank, put that money into high-yield assets to make it work for them, and then repeat the process. This isn't a secret. It's what banks do for wealthy individuals every single day. The only difference is that no one has explained how it works in plain, simple language. You've been led to believe that debt is a trap meant only for the poor, that investing with borrowed money is just gambling, and that true financial health means being entirely debt-free. Let me tell you something: if you don't understand the true nature of debt, you aren't protecting yourself. You are personally slamming a door that was wide open for you to trade up in life. In this episode, I'm going to pull back the curtain on the exact logic. Banks will never volunteer to explain why they love lending money to people who don't need it, and exactly how leverage and interest rate differentials compound into 8-figure portfolios within Taiwan's current mortgage and stock market environment. I will also show you exactly when this strategy works beautifully, when it becomes the crushing weight that ruins you, and the strict conditions you must meet before you even think about touching it. The first foundational rule: debt itself is not the risk. The gap between your interest rate and your rate of return is the risk, that you need to pay off loans as fast as possible to be stress-free. That concept isn't entirely wrong, but it is incomplete. It focuses on the emotion of debt while completely ignoring the mathematics of debt. What is debt at its core? It's renting money you don't currently have at a fixed cost. The rent for that money is your interest rate. If you take that rented money and deploy it into an asset that yields a higher return than the rent you pay, you pocket the difference. More importantly, that profit is built on a massive lump sum of capital you didn't originally own. That is the definition of leverage. Let's look at the actual numbers in Taiwan. The mortgage rates posted by major Taiwanese banks currently hover around 2% to 2.5%. This is a historically low interest rate environment. Meanwhile, SP Global's historical back testing shows that the SP 500 has delivered an annualized return of roughly 10.5% over the past. Data from the Taiwan Stock Exchange also reveals that the Taiwan Weighted Index has averaged an annualized return of about 7% to 8% over the past 30 years. What does this mean? If your borrowing cost is a 2.2% annual interest rate, and you park that capital in assets with historical annualized returns of 8% to 10%, you are capturing an annual spread of 5.8 to 7.8 percentage points. And that spread is compounding on the bank's money, not yours. This isn't speculation. It's pure mathematics. Let's paint a picture using a scenario every Taiwanese person knows. Suppose your home is currently worth 15 million NTD, and your remaining mortgage balance is 8 million NTD. That means you have 7 million NTD in home equity. You apply to the bank for a 3 million NTD cash-out refinance at an interest rate of 2.2%. Your annual interest cost is roughly 66.0 NTD, which breaks down to about 500 NTD a month. You take that 3 million NTD and set up a dollar cost averaging plan into the 50 ETF. Assuming a conservative 7% annualized return based on Taiwan's historical index performance. Though past performance never guarantees future returns, the asset generates 210.0 NTD a year. Subtract your 66.0 NTD interest cost from that 210.0 NTD return, and you are left with a clean annual net profit of 144.0 NTD. That's an extra 12.0 NTD in your pocket every single month, all generated by bank capital without touching a penny of your original savings. I know exactly what you're thinking right now. This only works if the market goes up. What happens if the market crashes? Fair point. I accept that challenge. and I will address it head-on in rule number 3. But first, I need you to understand one thing clearly. If you invest with your own cash and the market crashes, you still lose money. The real issue isn't the leverage itself. It's whether your interest rate spread is wide enough, and whether your repayment capacity is rock solid. This is exactly why some people use leverage to retire early, while others use it to drive themselves straight into bankruptcy. The outcome isn't determined by the debt instrument. It's determined by how you wield it. The second foundational rule: banks don't lend money to people who actually need it. They only lend to people who can prove they don't need it. Have you ever noticed this bizarre paradox? When you are genuinely desperate for cash, banks are impossible to deal with. The rates are sky-high, and the terms are brutal. But when you don't need money at all, banks call you constantly, begging you to refinance, offering the lowest rates and the maximum credit limits. This isn't banks bullying the poor. It's the cold commercial logic of risk pricing. According to loan statistics from the Financial Supervisory Commission (FSC), the core underwriting logic of Taiwanese banks boils down to just two things: collateral value and repayment capacity. Real estate is the ultimate collateral for Taiwanese banks because its liquidity is highly predictable, and its value is relatively stable. If a borrower defaults, the bank can simply liquidate the property to recoup its funds. That's why the moment you own a home, banks are eager to lend to you at the lowest tier of interest rates available on the market. If you try to borrow 3 million NTD through an unsecured personal loan, your rate will likely range from 4% to 8%. But if you put your house up as collateral, that rate plummets to 2% to 2.5%. This gap is spelled out in black and white across the posted rates of every major bank in Taiwan. And this price difference is what determines whether your leverage makes financial sense. More importantly, there is an unwritten rule in the Taiwanese banking system for high net worth clients. If your property value is high enough, your loan-to-value ratio is low, and your income is stable, banks won't wait for you to apply for a refinance. They will actively approach you with wealth management proposals, offering premium terms you could never get at a standard service window. They don't do this because they like you. They do it because you represent the lowest possible risk. The money they lend you is practically guaranteed never to become a bad debt, and the interest they collect from you is a guaranteed profit stream. This logic exposes a fundamental truth: the Taiwanese financial system is hardwired to help people who already own assets compound their wealth more efficiently, not to help those with nothing start from scratch. This isn't a criticism. It's a fact. And those who understand this truth stop complaining about how unfair it is and start figuring out how to get inside the system. I know what you're thinking, but I don't own a house, so none of this applies to me. Let me tell you, the core logic of this episode isn't just for homeowners. It's about helping you master the mechanics of interest spreads and leverage. That way, whenever you do acquire any form of collateralizable asset, you'll know exactly how to leverage its value instead of blindly obsessing over paying it off as fast as possible. The third foundational rule: there is a hidden mechanism behind the strategy that banks will never openly tell you, and it is heavily rigged in their favor. Why are banks so willing to give you low interest rates and let you invest the money? It sounds like they're helping you build wealth. But the truth is they don't care whether your investments make money or not. All they care about is that you pay your interest on time every single month. Let's break down the bank's business model when you pull out 3 million NTD at a 2.2% interest rate. The bank locks in a guaranteed 66 NTD in annual interest, which amounts to 1.32 million NTD over 20 years. No matter how much money you make with that 3 million NTD, even if you turn it into 5 million NTD, the bank still gets exactly 1.32 million NTD. It is fixed, guaranteed, and completely decoupled from your investment performance. Their revenue does not depend on your success, but your legal obligation to repay them doesn't depend on it either. This structure is flawless for the bank. That's exactly why they aggressively market refinance products. Their risk is near zero. They hold your deed, and their income is locked in, while you shoulder 100% of the market volatility. When the market goes up, you capture the spread, the bank gets its interest, and everyone is happy. When the market tanks, you take the loss, but the bank still gets its interest. And if financial pressure forces you to liquidate your portfolio at the bottom of the market, turning a paper loss into a permanent one, the bank doesn't lose a single cent. Data from the FSC Banking Bureau shows the real estate-related loans have long accounted for over 35% of total bank lending in Taiwan. This figure tells you that real estate mortgages are the absolute lifeblood of bank profitability. Of course, they've crafted a compelling narrative to make refinancing look incredibly lucrative. The more you borrow, the more they make. This doesn't mean refinancing is a mistake. It means you must be crystal clear about your role in this equation. The bank locks in guaranteed interest, while you chase variable investment returns, and you alone bear every ounce of that uncertainty. Only when you see this clearly can you evaluate with absolute sobriety whether this leverage is worth taking on. Let's run 3 side-by-side scenarios to see exactly how much the final payout changes for the exact same 3 million NTD refinance, depending on the execution path you choose. The baseline conditions for all calculations are a 3 million NTD refinance, a 2.2% interest rate, a 20-year term, and a projected 7% annualized investment return. A conservative estimate based on the 30-year historical performance of the Taiwan Weighted Index, though actual returns will always fluctuate with the market. All numbers below are illustrative projections. Scenario 1: the wrong path using the refinanced money for lifestyle inflation or high-risk speculation. This individual pulls out 3 million NTD. They blow 1 million NTD on home renovations and dump the remaining 2 million NTD into a single stock recommended by a friend. Within a year, that stock plunges 40%, leaving a paper loss of 800. Zoro NTD. Panicking, they cut their losses and sell, locking in a permanent 800. Zoro NTD. Yet, the loan remains, and the monthly principal and interest payments are still due. The 1 million NTD spent on renovations was pure consumption. That asset value is zero. The 2 million NTD investment shrank to 1.2 million NTD. Over 20 years, the total interest paid to the bank at 2.2% totals roughly 750. Zoro NTD, bringing their total financial bleed to well over 1.55 million NTD. On top of that, their monthly mortgage obligation has jumped by about 16. Zoro NTD compared to before the refinance, strangling their if they hit a career speed bump or a medical emergency. Their ability to repay will utterly collapse. Scenario to the right path deploying the refinance capital into low-cost index. This individual takes the 3 million NED and channels the entire amount into a broad market index ETF listed in Taiwan, like 6,208 or 50, using automated stagger tranches to smooth out pricing over time. Crucially, they leave their separate emergency fund completely untouched. Their monthly salary is high enough that even after paying both the original mortgage and the new refinance payment, they still live comfortably without ever needing to touch the investment to cover daily expenses. Assuming a 7% annualized return, that 3 million NTD compounds to roughly 11.6 million NTD over 20 years. Subtracting the total interest cost of about 750 Zoro NTD, the net profit spread is approximately 7.85 million NTD. In other words, by leveraging 3 million NTD of the bank's money, they generated nearly 8 million NTD in extra wealth over the decades without touching a dime of their own principal. In real-world terms in Taiwan, 8 million NTD buys a 20-ping vintage apartment in the greater Taipei area. It is the financial runway that allows a couple to retire 7 to 10 years early. It is the full tuition fund for 2 kids to go through college and graduate school. But this outcome only happens because they never pause their contributions, never panic during market downturns, and possessed a stable monthly income that insulated their daily lives from market swings. Scenario 3: the extreme stressed est encountering a 2008 level market meltdown. Historical data from SP Global shows that during the 2008 financial crisis, the SP 500 plummeted over 56% from its peak. Taiwan Stock Exchange records show the Taiwan Weighted Index suffered a parallel drop of over 50%. Suppose you refinanced 3 million NTD at the end of 2007 and dumped it all into an index ETF. By the absolute market bottom in March 2009, your portfolio's paper value would have withered to about 1.55 million NTD, showing a staggering paper loss of 1.5 million NTD. What does a disciplined investor do here? They verify that their emergency fund is fully intact. And they keep paying the mortgage on time every month because their repayment source is their day job, not their investment returns. They don't need to liquidate at the absolute bottom, so that paper loss never becomes a permanent loss. By 2013, the Taiwan weighted index fully recovered its 2008 peak, and a 300 million NTD broke even before continuing its long-term upward trajectory. What does the undisciplined investor do? They panic in 2009, selling everything to salvage 1.5 million NTD in cash, locking in a catastrophic 1.5 million NTD permanent loss while the bank loan remains fully due. They are forced to use their depleted capital just to pay back the bank. The final result: their assets are wiped out, their debt remains, and their financial foundation is completely shattered. This extreme scenario proves that the core risk of leveraged investing isn't that the market will drop. It's whether you have the financial fortitude to hold through the absolute bottom. And that fortitude depends entirely on your repayments or being a stable salary, never the investment returns themselves. The point of this logic isn't to peer pressure you into debt, nor is it to diminish the value of conservative financial planning. It is to show you that debt is an instrument whose value depends entirely on where you deploy it, how wide your interest spread is, and whether you possess the resilience to hold through extreme market crises without being forced to sell. Let's look at the exact parameters that dictate when this tool builds you up and when it crushes you like a stone. There are 3 classic green light use cases. First, positive cash flow rental property. You use the refinance funds to purchase or renovate a property that yields stable rental income, where the monthly rent securely covers the mortgage interest, management fees, and vacancy reserves while still leaving a net positive surplus. This is a positive cash flow leverage structure. The asset pays off the debt, meaning this is the healthiest form of leverage. Second, broad market index investing backed by historical data. You route the refinance capital into low-cost index ETFs like Taiwan S50, 6208, or the US markets VOO, capturing the steady spread between historical annualized returns and your loan's interest rate over a long, non-market time horizon. This is exactly what the investor in scenario 2 did. It works provided the timeline is long enough and the repayment source is completely divorced from the portfolio. Third, scaling an already profitable business model. You own a business that is already consistently generating revenue, and you use the refinance to expand production capacity or clear a specific operational bottleneck. The projected new revenue from this expansion clearly and reliably covers the new debt service. This is entrepreneurial leverage, where the underlying risks are highly calculated and controlled. Conversely, there are 3 classic red light traps. First, consumer debt. Using a refinance to fund home renovations, buy a car, take vacations, or purchase luxury goods. These expenses generate absolutely zero cash flow. The asset value vanishes instantly, but the liability remains forever. This is the worst possible leverage structure. Second, speculating in assets you don't understand. Buying hot stock tips from friends, trading short-term futures, or messing with leveraged ETFs. If you cannot explain the underlying business logic of the asset, yet you enter the market using borrowed capital, you will lack the conviction to hold when the market turns against you. You will inevitably panic, sell at the bottom, and turn a temporary dip into a permanent financial disaster. Third, debt driven purely by FOMO or anxiety, watching everyone else make money, panicking that you're falling behind, and letting raw emotion dictate a refinance decision instead of cold math. This type of leveraged play almost always disintegrates during the very first major market correction. Understand this boundary clearly. Debt is a blade. Wielded correctly, it's a scalpel. Wielded poorly, it's a weapon. What determines the difference is whether you have honestly answered 3 questions before pulling the trigger. Is the interest spread wide enough? Is your repayment source rock solid? Do you have the capacity to hold through an extreme market crash without selling? This isn't friendly advice. This is your financial baseline. If you cannot check off these 4 rules, stop everything, unfix them first. Don't try to fill a bucket that has holes in the bottom. Rule 1: you must have at least 6 months of living expenses secured and an emergency fund before you even look at leverage. 6 months of bare minimum living expenses parked in liquid cash, high yield savings, or money market funds that you can draw from instantly. This does not mean the liquidation value of your stock portfolio, nor does it mean your home equity. It means cold, hard cash. This rule isn't about being overly cautious. It's about basic structural integrity. If you don't have an emergency fund, your leverage repayment relies entirely on a single thread: your employment income. The moment you face a layoff or a major medical emergency, your only survival option will be to liquidate your investments. And that liquidation will almost certainly happen during a market trough, transforming a paper loss into a permanent financial blow. This is a tragedy that can be entirely avoided with a simple cash buffer. Rule: to your total monthly debt payments must never exceed 35% of your net monthly income. When Taiwanese banks review refinance applications under FSC guidelines, they typically mandate that a borrower's total monthly debt obligations do not cross 30% to 40% of their. This threshold isn't arbitrary. It's based on deep statistical risk models of default behavior. But I am giving you an even stricter, more conservative self-assessment benchmark. Your total monthly debt service, including your original mortgage plus the new refinance, cannot exceed 35% of your net monthly income. Crossing this threshold means your daily cash flow is stretched to thin. The moment life throws a curveball, your financial structure has zero shock absorbers, and a strained financial state is the single biggest driver of catastrophic decision-making. Math is a hard boundary, not a moral judgment. Rule 3: before allocating a single cent of refinance capital, you must be able to state the exact business logic of the asset, its historical return data, its maximum historical drawdown, and whether you can emotionally stomach that loss. For an index ETF, this means knowing exactly which index it tracks, its expense ratio, its worst historical crash, and the precise spread between your loan interest rate and its long-term annualized return. For a rental property, you must have calculated the net rental yield, factored in vacancy rate assumptions, and subtracted maintenance costs to guarantee the cash flow remains positive. If you cannot explain it simply, do not borrow the money. Conviction based on deep understanding is the only thing that keeps you from selling when panic hits the market. Without that understanding, you will run the moment the market takes its first major dive. Rule: for your passive income or stable rental yields must be able to cover the monthly interest of the refinance to qualify it as a viable long-term tool. If you invest 3 million NTD from a refinance into 50, the dividends generated must be conservatively modeled against market fluctuations to ensure they can, at bare minimum, cover the monthly interest payment of roughly 500 NTD. If your asset cannot even cover its own interest cost, it means your leverage is entirely subsidized by your active salary. The moment your paycheck stops, your entire investment thesis collapses. Having passive income cover the interest cost is the exact line where leverage transforms from an existential threat into a strategic tool. Take these 4 tactical steps today. Step 1: open all your banking apps and loan statements, and calculate your true net worth down to the penny. Log into your online banking portals. Add up the total market value of your savings accounts, time deposits, and investment portfolios, and write that number down. Next, aggregate every single liability you owe: your remaining mortgage balance, car loans, personal loans, and outstanding credit card balances. Subtract your total liabilities from your total assets. That final number is your actual net worth today. A lot of people avoid calculating this because they are terrified of facing reality. But this number is the absolute baseline for every financial decision you will make from this point forward. You must know exactly where you stand before you can map out where you are going. If you own real estate, check its current estimated market value. Subtract your outstanding loan balance, and that delta represents your potential actionable equity, the foundational asset base a bank would theoretically look at if you applied for a refinance. Step to calculate your maximum safe leverage ceiling based on your net worth and income structure. Then establish an independent investment account with automated mechanics. Take out a calculator and multiply your net monthly income by 35%. This is the absolute ceiling for your total monthly debt payments. Subtract your current monthly debt obligations from this number, and the remainder is your safe operational space for new debt. If this number is positive, you have room to consider a refinance. If it is negative, your current debt load is already too high, and your exclusive focus should be on paying down existing debt rather than taking on more. If you do have safe operational room, open a dedicated, standalone brokerage account with a compliant local firm in Taiwan specifically for this strategy. Set up an automated monthly deduction to buy 50 or 6,208. Make this process entirely mechanical so that short-term market sentiment can never interfere with your execution. Step 3: write down your 3 core rules for using leverage in your phone's Notes app today. Take a screenshot and save it. Rule 1: My refinanced capital will only be deployed into index tracking assets with extensive historical return data or positive cash flow real estate. It will never touch any asset whose underlying business logic I cannot explain. Rule 2: My total monthly debt service will never exceed 35% of my net monthly income. If it crosses this threshold, I will not take on any new liabilities. Rule 3: If the market drops by more than 30%, I will not liquidate. I will verify that my emergency fund is intact, confirm my salary is stable, and continue holding, completely ignoring short-term market noise. Once written, screenshot it and save it to your phone's favorites album, stamped with today's date. These 3 rules are written by your rational self today to govern the panicked version of yourself in the future. Trust the rational version of you. Step for conduct and net worth audit at the end of every year, focusing exclusively on the trajectory of 3 core metrics. First, how much did your total assets grow compared to last year? Second, how much did your total liabilities decrease? Or if debt increased, did it generate a proportionally higher increase in asset value? Third, did your debt-to-income ratio improve or worsen? Compare yourself only to your past self. If the trajectory is right, keep going. If the ratios are moving toward a healthier balance, stay the course. The moment you notice your debt ratio climbing without a corresponding expansion in your asset base, immediately freeze all new borrowing and prioritize rebalancing your financial structure. If you are currently caught in a market downturn and feeling the squeeze, execute this exact sequence. First, verify that your emergency fund is intact and that your daily life is secure. This is the single most vital step because decisions made in a state of panic are almost universally wrong. Stabilizing your lifestyle allows you to pivot out of emotional panic and back into operational rationality, which is essential for taking the correct next. Open the rules memo you wrote in step 3. If you haven't, a temporary paper loss in the market is not an emergency that requires immediate action. Your actual priority is simply maintaining your stable source of income. If you genuinely must reduce your debt load, follow this strict hierarchy for mitigating exposure. Tap into alternative non-core assets first, such as liquidating time deposits or low-yield idle cash, to pay down a portion of the refinance principal and ease monthly cash flow pressure. Do not default to selling off your depreciated investment positions, as that instantly converts a temporary paper fluctuation into a permanent, unrecoverable capital loss. Only as an absolute last resort should you consider scaling back your investment positions. And even then, do it in staggered, partial tranches, never in one emotional liquidation. Once the acute pressure subsides and your daily cash flow stabilizes, immediately sit down to audit your leverage rules. Identify the precise miscalculation that landed you in that vulnerable position. Correct the flow, and re-engage the system. Do not abandon the entire methodology over a single execution error. The underlying mathematics of the strategy remains sound. The error lay in a specific operational detail. Find it, fix it, and keep moving forward. This episode is about the cold math of debt, not the morality of debt. There is a class of investors in Taiwan using this exact framework to secure their financial independence years ahead of schedule. They aren't inherently smarter than you, but they mastered one truth much earlier: interest rate spreads are real. Leverage is a tool, and the value of any tool is dictated entirely by the person wielding it. Never forget the core thesis of this episode: banks love lending money to people who don't need it. The ultimate bottleneck is never whether you can get the money. It's whether you have a bulletproof system to make that money yield a higher return than the cost of the interest. Now I want to ask you, open your banking app, run the math on your true net worth, and drop that exact number in the comments section below. No explanations needed. Just the raw data. Whether it's positive or negative, own it. Because knowing exactly where you stand on the map is the absolute first step toward changing your destination. If this episode shifted your financial perspective, hit subscribe and turn on notifications. We are going to keep tearing down the foundational rules of the Taiwanese financial system that no one else will ever volunteer to tell you. This is the Money Lab. 44.